The infamous call option. Everybody loves to do call options. Unfortunately, most people get totally wiped out doing that. I'm not going to lie with you guys. Like, I made a lot of money. A lot of this $1.2 million right here is because of doing call options. But I'm going to be honest with you, I didn't always make money doing them. So, in this video, I'm going to walk you through a decade of things that I learned about call options, how to do them profitably, and another strategy that we could use in combination with call options to get appreciation with calls, and we could get cash flow with this other strategy. So this video is really going to help you guys out a lot. I know a lot of people really do a lot of call option trades, but unfortunately most people just they have the wrong idea. They don't really understand how the mechanics actually work. They don't understand the timing of it, the strike price, the expiration date, when to do this stuff in the lowest risk way, in the most repeatable way. That's what we're going to cover in this video right here. So, really quick, what are call options? It's just a way to leverage a magnified move of a stock that you're expected to go up. You can either buy shares and you're going to make money if the share price goes up, or you could buy a call option where you're basically allowed to buy shares at a certain price and a certain time frame, and you're paying someone a premium, like an insurance premium, to be able to do that. If the share price goes way up, you're going to make a lot of money. But if the share price goes down or doesn't really do anything, that call option is very likely to expire worthless and you will lose all of your money on the call option. So, a really common mistake that so many people make is they do call options with the wrong strike price, the wrong expiration date. They have too much of their portfolio overall in call options. Their ratios are totally out of check. We're going to cover all that in this video right here because, I see a lot of people making these mistakes and I'm just sick of seeing that out there. So, before we dive into my Charles Schwab account, we're going to dive over to the charts and we're going to go through a couple companies of why it would make sense to buy call options on them and just how you could do this in a repeatable, sustainable way. Because again, like so many people just get totally clobbered with this because they see the idea of, oh my God, I could turn $1,000 into $10,000 overnight. And while that is possible, you're kind of looking for a needle in a haystack, and you're probably going to find the haystack, not the needle. Okay, so this right here is a 5-year chart of NVIDIA. As I talked about in all my previous videos, this line right here corresponds to the earnings per share growth. And when we understand that NVIDIA might be a little bit stretched overvalued right here and maybe a little bit undervalued right here. Again, up here, maybe it's a little bit overvalued, maybe it's close to intrinsic value right now. So the key thing that I want to point out is this. When NVIDIA was falling right here on this Liberation Day tariff stuff, let's see how much it actually went down from peak to trough. Down roughly, call it 37% peak to trough. Did the actual fundamentals of the underlying business change in that downturn right there? Like the earnings per share growth line is going up and to the right, but the stock was going down and to the right. Like, does this kind of flash like opportunity for you right there? Did the fundamentals actually devalue in that time frame right there? The answer is no. The company's still growing, earnings per share is going up, revenue's going up. It still looks really, really good. So in a time frame right here when the typical herd investor is freaking out, panicking, watching Jim Cramer online saying, "Oh my God, I need to sell all my stocks. I need to get out of the market." Smart investors were buying call options right here. And we're going to dive into NVIDIA here and just kind of break down a little bit of the fundamentals and a little bit more of why this made sense to do it right here because it becomes very obvious. So if we head over to the valuation on NVIDIA, we go to a 3-year chart and we take a look at what the PE ratio of NVIDIA was April 3rd. Roughly 20 for the PE ratio for NVIDIA. That's the price earnings ratio level. And the reason why we care about the price earnings ratio level is because this just tells you, hey, I'm paying this much for the share price and I'm getting this much in per share profits. The closer those two things are together, the more a company could potentially be viewed as undervalued. So a company like Nvidia trading at 20 times earnings, and if we take a look at what's going on with the revenue growth and the earnings per share growth, it does kind of become obvious like, oh, this company is clearly like, look at this revenue trend going up and to the right for 25, 26, and 27. Really strong revenue growth. Look at earnings per share growth, clearly up and to the right. I mean, this is almost doubling every 2 years for earnings per share growth. It did more than a double from 24 to 26 estimated. Like, this company is growing like crazy. So when opportunities like this pop up, where you see the stock falling 37% in just a few months, this makes sense to buy some call options right here. On top of that, let's think like the typical retail investor. What are they thinking right here? Even institutional investors at that, what are they thinking right here? Well, I'll tell you what they're thinking right here first. As NVIDIA is pumping out of the wazoo and going straight up to the moon, as people say, they're willing to buy call options up here because they just think the stock price, like, let me draw you a line right here. They think the stock price is going to go from here and go like this. And they're like, I'm going to buy it here and I'm going to sell it here and I'm going to make a crap ton of money. Unfortunately, that's not how the stock market works. Things happen out of right field, left field, corner field, whatever. Unexpected things happen. And to be honest with you, tariffs were kind of expected, but how hard Trump put them in place, it was more than what people were expecting. So the market went down on that. And on top of that, the market was a little bit overvalued right here. So it was just justified to take a little bit of a breather. So while people are paying top dollar for calls right here because the stock is going up, the herd wants to pile into them because that's the cool thing to do. Everybody's doing it. They're bidding up the premiums on the call options. Call option premiums are going way up. And that's not necessarily the best time to buy calls because you're essentially getting less and you're paying more for it. So, on the flip side, if you're just patient and you could have the ability to just sit on your hands and be a long term investor, we're going to have volatility like this all the time. You just have to be patient and wait for it and not get FOMO. So, when we get volatility, nobody down here wants to buy call options. Everybody wants to buy put options, to be honest with you, because they just see the stock market like, again, let me draw you another line. They see the stock market going down like this, like just straight down to the bottom. And that's not usually what's going to happen, especially on a company like Nvidia. So while the herd is buying put options down here because they're freaking out, they want downside protection in their portfolios, there's really nobody that wants to buy a call option down there. So think about that. Nobody wants to buy a call option down there. The stock is clearly undervalued right here. The sentiment is bad. The call option premiums are low. That is a time to deploy capital into these companies and be patient and buy call options. Okay, so we buy call options and say that somehow we perfectly time the bottom of the market perfectly. And I'm not saying I could time the bottom of the market perfectly. Sometimes we get pretty close, but you don't have to get the bottom of the market perfectly. And I'm going to show you on United Health stock in just a second how I bought calls on this dip. They initially went pretty deep into the red, and then now I'm actually up a lot of money on them because I was patient and I was capturing the move that I was expecting to come. We'll talk about that one in just a second because it's a really good learning lesson there. But smart investors were buying calls down here, and they were not buying 1 month, 2 month, 3 month calls. They were buying leaps. They were buying call options longer than 1 year in duration because they know the earnings per share growth line is up and to the right. They know that while we can't time the bottom of the market perfectly, if we get close to the bottom, when something is grossly undervalued, just think of this as like a rubber band. The stock is stretched below the earnings per share growth line and it wants to fling back up and revert to the mean line of earnings per share growth. That is what stocks do in the long term. They are going to follow what earnings per share does. This applies to every single company out there. Short term, yes, there's going to be bumps. It's going to go up, down, above and below the line. We get that. But we are just going to simply use that volatility as opportunity to capitalize on this stuff, guys. Like, we don't have to complicate this. It's not hard to make a lot of money in the stock market. You just have to buy a good company at a good price with a moat, with pricing power, with a durable competitive advantage. And you got to be patient and be okay to hold it for the long term. If you're cool with that and you did your research and you have your conviction in that trade, hey, maybe you bought call options right here before the bottom was even formed, and maybe it went down a little bit, but you know that you're getting Nvidia at an undervalued price, and you just be patient and you ride the wave back up. So I was buying 1 year, 2 year call options right here, and I was being patient, and I made a lot of money on Nvidia calls. Let's go to United Health. I'll show you inside my account because I still have one of my call options open on United Health, but I want to show you here how I initially lost money on these United Health calls, and then I did make a little bit of money on them right now. So let's talk about that. So here's the deal. United Health, they had some bad news that came out. The stock fell like a lot from peak to trough. We'll go to this dip right here. The stock fell 54% in literally just a couple weeks. Crazy drop right here. So what was I doing on United Health? Well, as you could probably guess, I was selling puts right here. I was taking the premium from the sold puts. I was buying shares and I was buying calls. This video is largely about buying calls. I'll link a video about selling puts and generating cash flow at the end of this one, but I was buying call options right here. And while when I initially deployed my money into United Health on these calls, yes, the stock went up roughly 15%. And everybody was like, in the Discord, everyone's like, oh my God, Brandon, you timed the bottom of United Health perfectly. And I'm like, be very careful because it's very likely to be very bumpy. We know where the stock is going to go in the longer term, but in the short term, we are not going to declare victory yet. And it was so funny because this is literally exactly what happened. Stock went up 16%. We made a little bit of paper money. And then the stock went down from our basis roughly 12%. Everyone's in the chats like, oh my God, what do we do? Why is United Health going down? I'm freaking out. And guess what I did? I had conviction. I did my research. I knew earnings per share was going to recover eventually. So I was deploying a little bit more money on this further dip right here where it went down 12% from my initial basis. So I deployed right there. And guess what? United Health rebounded sharply off of that dip, up roughly 50% from when I added more call options. I had 3 leap options that I added right there. I'll show you in my Schwab account to show you proof that I actually did this trade because people are going to say, I don't believe that you actually timed the bottom of the market perfectly right here. Again, I'm not always going to do it perfectly, but my point is this. I added more shares when United Health went down because I do not claim I could time perfect bottoms, but I know where the stock is likely to go in the long term. In the short term, it's going to be bumpy. In the long term, it's going to be very good. So, if we take a look at where the stock went from my initial basis to current, yes, it's up roughly 20%. So, again, you just have to be patient with this stuff. You don't want to play games with 1 month, 2 month, 3 month call options because you have this thing called theta where every day that goes by in your call option contract, it's going to be worth a little bit less. So I bought 1, even 2 year call contracts right here to capitalize on the rebound that's likely to come. This is just one company I did this on. I did this on United Health. I have call options on Meta right now. And you know what? Let's just go dive into Schwab right now and I'll show you what's going on in there. Quick little recap here. Let me hit refresh. Up 165% in 2 years, 766,000 bucks. No gambling, no day trading, doing stocks and options the right way as an investor, buying things when they're grossly undervalued, and selling puts, buying calls, buying shares, and just simply being patient. But let's dive into my account a little bit here. Let me make myself a little bit smaller. By the way, I have other Schwab accounts. That's why the value right here only shows 967K. I do have a few other accounts within Schwab, so if you're wondering, that's why. Now, I have this United Health call right here. I realize that it's only one call. It only has a market value of $12,000. I did have 3 more calls like this that went actually out longer in duration, but you could see I'm up 106%. I also have NVIDIA calls like you can see right here on the bottom. NVIDIA calls, I'm up a little bit on those, but United Health we're doing very, very good on. But my point is that if I would have did short duration calls, I guess, there's a lot of volatility that's happening right here. I probably would have lost my butt on those. And on top of that, take a look at what percent of my account these United Health calls are. This is 1%. These NVIDIA calls are 3%. These Meta calls are roughly 4%. You don't want to go like 20, 30, 40% of your account in call options because I want this to click for you. Like, this is a really important thing. And I know I'm kind of bouncing around, but just conceptualize this with me for a second. If you put 30% of your account, for example, in call options, when the market's going up, you are going to crush it. You're going to do like really, really good. But think about it this way. When the market goes down, because there's always things coming out of left field that could happen that could make the market go down in the short term. Long term, yes, probably up and to the right. But short term, it's going to be very bumpy. And if you have 30% of your account in call options and call it like you have an average duration of 6 months for your expiration date, that means you have 30% of your account in something that could potentially go down to zero. And I don't like that. Like, that's too much. So, me personally, I never like to have my account. Depends how much conviction I have, depends the overall market valuation. Like, at the time of recording this video, the market is a little bit expensive. So, I want to have less risk, less sold puts, less long call options in my account because I just think the future expected returns might be a little bit below the average, is what we're going to get. I could be right, I could be wrong. Either way, it doesn't matter because I'm going to capitalize either way and I'm going to do just fine. But my point is that you just don't want to have too much of your account in something that could expire at a value of zero. Always keep your ratios in check. Don't put too much of your call option exposure into one company or one ETF. I mean, ETFs are different because there's a basket of companies in there, but one single company, like I see people put 20% of their account in NVIDIA calls, and I'm like, you are insane because anything could happen with that company. You just want to be more conservative because trust me, if you do this long enough, there's going to be things that come out of left field that are going to wipe you out and you're going to wish that you didn't do that. Okay, so let me go over here to realized gain loss. And this was those United Health calls that I was talking about. I bought them for 10K, sold them for 38K, made like 28K on those. I also had more sold puts that I had, made $23,000 on those. So I made over 50K on United Health and I still have some stuff opened up on them. But like, the name of the game is this. In order to build enough conviction to, buy a decent amount of your account, call it 5% or whatever, in call options on any individual company or ETF. Deals like that simply don't come around every single day. They come around once a month, twice a month, whatever, but they're not there every single day. So the trades that I do highly convictive plays, plays that I know everything about the company, all the details, all the fundamentals, all the technicals, everything. I know all that stuff. And when the setup is just right, I deploy. Fundamentals are very important to me. Technicals are very important to me. And if we dive into Discord, I have a chart that's already set up for you guys. It's so easy to track. Basically, all you do, we'll do this in real time actually if you want. Let me show you my screen and get out of the way. So let's just take, you go / command, you do chart, and let's just do actually, let's do meta for example. You do this, and I built these charts out. They're all preset in my Discord. So it's going to load up, and I'll make a big screen for you. You can see that fundamentally, I'm a big fundamental guy. You guys know that. But technically, it's closer to the Bollinger Band when it was down here for Meta. The RSI was pretty low. This just kind of confirms my fundamental analysis of, are we getting in at a good technical spot? Are we getting in when the stock is beat up? Are we getting in when things are a little bit undervalued and oversold? The answer is yes. So Discord is a really good place to look at charts too, along with everything else that we do in there. So let's summarize all this. Most people are simply going to lose money with call options. I am not going to make money on every single trade. I'll be the first one to say that. But overall, on balance, we crush it with call options. We do way better than what most people do, way better than what the S&P 500 does. This is just a tool in our toolbox to capitalize with. Longer duration contracts win. More time to grow earnings per share, more time to make that company more valuable, more time to go up and to the right. You want to buy when things are beat up, when people are, a little bit scared out there, when sentiment's bad, and when call option premiums are a little bit lower than what they typically are. That's when you want to buy call options right there. So hope you got value from this video. If you want to watch another video that is really good on more option strategies, selling covered calls, selling puts, all that good stuff, because I don't sell puts cash secured, I sell them portfolio secured. It will blow your mind if you learn about that. Watch this video right here. Trust me, I'm not clickbaiting you to it. It is going to help you out a lot. You're really going to like that video. There's a lot of people that said they really got value from that video. So I'll see you guys there.